Our guest today on GoldCore TV thinks it's very likely that in the next 10 years, we will be moving on to a new gold standard. Jan Niewenhuijs is a gold analyst who is bringing the chat around gold demand firmly into the 21st century. His analysis and relentless questioning has put him on the map as the go-to expert when it comes to gold reserves, the movement in gold, and the international role of gold. We invited Jan into the GoldCore studio because we have watched his research for some time and we wanted the opportunity to ask him all about it. For many gold market commentators, it is a given that we will return to a gold standard because that's just what has to happen. But where are the hard numbers for this? How will you convince money printing central bankers to make such a seismic shift? This is where Jan's commentary and analysis comes in. I am sure you will find this interview incredibly interesting and won't be able to help but be impressed by the audacity of Jan to ask questions directly to the central banks. If you have any thoughts or comments, then please put them in the comments below or tweet us. And why not subscribe to GoldCore TV whilst you watch? Enjoy the interview.
Jan Niewenhuijs, welcome to GoldCore TV.
Thanks for having me.
Now, no matter where you look at the moment, we've got inflation everywhere, and it's a problem for most people. Now, you think that this is viewed by some, i.e. governments, as a potential solution, or at least a means to an end, as they attempt to inflate away debt and possibly usher in a new monetary system and potentially one that's backed by gold. Talk to me about that for a moment.
Yeah, well, I think, of course, people that have a lot of debt, or governments or corporations or whoever, and has a good cash flow, likes inflation because it lowers the debt burden. And that's true for governments, especially because they, in recent times, they have accumulated all the debt, right? They bail out the banks or whatever, and the debt is being funneled towards the government, and then the central banks buy the government bonds. But so in a sense that it's good for them, but I think it won't be a way out for them. I don't think we can. I think we're in a debt trap, and there is a certain debt saturation right now, which is hurting growth, and it's not going anywhere. And I don't think inflation is the solution to this problem of the international monetary system that we have right now. So I think it's very likely that in the coming 10 years, we go to a gold standard. And that's not because I'm an ideologist or something. I'm a gold analyst. And my conclusion is based on what I see happening in the markets, but also what central banks are doing. And okay, so let me start with the conclusion. Two very important things that I see and have researched. So the first is that monetary gold reserves are much more evenly distributed across countries around the globe, proportionally to GDP. So if you compare Europe to the US, China, Russia, they all have more or less the same amount of gold reserves relative to their GDP. That is a requirement for a proper monetary reset, because such a monetary reset can be viewed as or compared to a poker game. So if you start a poker game, the chips, of course, have to be evenly distributed, or it's an unfair game. So if you start over with a new monetary system, the gold, based on gold, the gold has to be evenly distributed. And then you can start off with an equitable and durable international monetary system. For example, if one country or one continent has all the gold and we would start with a gold standard, then other countries would need to buy in, then the relative gold price would go up, and you would get inflation in certain countries. Just, you start with an unstable system. Now, the other thing is that we don't have a gold standard now. Now we have a credit-based monetary system. And you probably know this, if you can print money, it's politically too tempting to print money every time there's a crisis. So what's happening is that with every crisis, they print more money. And what you get is asset inflation, inequality, zombification of the economy. Then growth declines, and they need more need to issue more debt to kickstart growth again. So this is a cycle which they can't get out of, in my opinion. Now, there's a very interesting trick. It's actually quite simple that central banks can do to extinguish the debt. As I just said, you know, most of the debt in society is being brought to the balance sheets of central banks, right? Via the government, it ends up at the balance sheets of central banks. They all have gold, and they also all have more or less the same amount of gold relative to GDP. Now, what you can do is revalue gold, say times 7 or 8, or it depends on a lot of things. We can talk about this later. And what you do then is not only cover the monetary base and to start off with a gold standard, but you also revalue the gold to create on the liability side of the balance sheet what's called a revaluation account, which you can use as capital. So if you have a very large revaluation account and you have a lot of debt on the asset side of the balance sheet, bad debt, you can cancel these two, right? You can write off the debt against the revaluation account. So by revaluing gold, we could, you know, have a fair monetary reset. And I think what's very important is, by the way, I like to mention that I wrote an email once to the German central bank. They're very talkative. And now, yeah, it's because they're so, you know, they reply within 5 minutes, etc. Okay, not 5 minutes, but it's better than in Turkey.
Yes.
And I asked them about, you know, accounting, about this revaluation account, and I was, you know, researching that. And in the end, I thought, you know, sometimes you just feel that the person on the other end is quite talkative, and so I asked, like, aren't you worried about the current debt situation in Europe? And are you thinking about how we can ever get out of this? I mean, taxes is kind of hard, and austerity is difficult, and inflation will be a disaster. Why not revalue the gold? And they replied something like, decisions that we may or may not take in the future, we would not like to discuss at this moment. So to the question, you know, have you ever considered revaluing gold? You know, the answer is they don't rule it out. And so that is, I think, very significant. I could put links below to, I've written about this.
Yes,
of course. So I think that is very important. Another important thing to mention is that this whole equalization of gold is being driven by Europe, and Europe has also done a few other things that I would like to address in a moment.
What do you mean by the equalization of gold?
So that is making sure that the gold, the monetary gold, is evenly distributed across nations, not only within the Eurozone, but worldwide. Europe really, so as you know, in 1971, Nixon closed the gold window, and Europe was not amused by that. First of all the monetary gold was in Europe by then. Europe was the biggest gold holder. The US tried to demonetize that gold. And also what happened, of course, was that the dollar was devaluing against the gold. So Europe had a lot of gold, which was being demonetized. And on the other hand, they had dollars, which were plummeting in value against the gold. So they were like, what's this? They definitely didn't want to go that way, but circumstances at the time made them to go along with the dollar standard for the time being. For example, you know, the total international financial system infrastructure was based on the dollar. You know, they couldn't change it overnight. They were getting military support from the US. You know, there were troops, there are still troops in Germany protecting them from the Soviets. It would have been very difficult to go to a different monetary system at that time. But France was very vocal about it. Germany couldn't say anything because they were blackmailed by the US with the troops. France was very vocal about it and was sort of leading developments at the time. So, and they also thought, and the European Economic Community also made a statement in the New York Times, I believe it was in 1973, that they wanted an equitable and durable international monetary system. So they also knew we have all the gold, right? All the gold, most of the monetary gold was in Europe. So they knew, so that's, you know, if we go to a gold standard now, you know, it wouldn't make sense, and it would be unstable from the get-go. So what they did is, first of all, think about the future, and they started making plans for the euro to have a dollar alternative. And also in the 1990s, European countries started selling gold, but it was not Germany and France and Italy that were selling gold, maybe a tiny bit. It was mostly the medium-sized economies like the Netherlands, Austria, Belgium, also Switzerland. It's not in the Eurozone, so I'm not going to talk about it, but mostly the medium-sized economies. And if you look now, I can send a chart, you can put it over. If you make a chart and you put the Eurozone countries in and you put GDP on one axis and the gold reserves on the other axis, you see it fits pretty well. And the only outlier is Spain, but Spain has more foreign exchange reserves than all the other countries, so I don't see it as a problem. And this is from observing the data, but I also have evidence from quotes from the Dutch Minister of Finance in 2011. He was asked in Parliament, so why did the Netherlands sell 1,100 tons of gold in the 1990s? And he answered, because we thought that we had too much gold relative to other important gold holding nations. That's exactly about equalizing gold reserves. I also have other, I have more evidence from European central banks about equalizing gold reserves, but I'm writing a next article on this and we'll publish it soon. But also, if you, for example, Switzerland is not even in the Eurozone, but if you look on the website of the Swiss Central Bank, it says the same. The Swiss Central Bank sold 1,400 tons of gold in the 1990s because it thought it had too much gold reserves relative to other G10 nations. Same thing. And at first you think, well, yeah, okay, probably. But if you, put together all the puzzles of the pieces of the puzzle, it starts to make sense. So that's what I did in the 1990s. And what's also interesting is that you have the Eurozone, but you also have the EU. And some countries are in the EU and they're about to enter the Eurozone, but that's going to happen in the future. And if you look now to countries, for example, Hungary, Poland, countries like that, that will in the future enter the Eurozone, what have they done recently? Buy gold to come on par with the other countries in the Eurozone. Ireland, if you look at the chart, had too little gold relative to their GDP. Ireland started buying gold a year ago. They have stopped doing that now, but this is the way how I see the European gold game. Other important things that I like to briefly mention is that European central banks have greatly changed the way how they communicate about gold. I mean, the former governor of the central bank of Germany has said that gold is the bedrock for stability of the international monetary system. On the website of the Dutch central bank, it read, gold always retains its value. If the monetary system implodes, the gold can be used to build up a new monetary system. They took down that article because me and other people were tweeting about it too much, I guess. But these things are being said on the websites. Another thing they did is repatriate gold. So they really are thinking about, where do we need the gold? We need it in London, of course, because it's a liquid gold trading center, but we also want to have enough of it at home for safety. And they have refined, upgraded their gold. So, for example, Germany and France have made sure that all their gold is upgraded to LBMA good delivery standards. So it's all liquid. That's like preparing for a gold standard, right? So that's how I see this whole European story led me to, of course, if you listen to Russia and China and other countries in Asia, they're very vocal about, we're going to get rid of the dollar, and we are pro gold. And a lot of in the gold community, everybody is like, yeah, Western central banks are against gold. They're suppressing the price of gold. No, they're not. European central banks are anything but against gold. They're cheering for gold. But I think a lot of people in the gold community are stuck with old narratives. Yeah.
It's very interesting now. So what we're seeing then, or what you're kind of uncovering there, what you're describing there is, as you call it, the common gold standard across Europe. And obviously we've got something similar being talked about by the BRIC countries as well. What would this actually mean for economies if or when they adopt this? Because there's a lot of financial discipline, monetary discipline that comes along with this concept. And I was going to say arguably so, but you don't even need to argue it. It's financial and monetary indiscipline that has got us into the problems that we're in at this moment in time. But that the fiat currency, that faith-based money effectively, has allowed a lot of flexibility over the years in terms of whether it's been not necessarily a good thing, but being able to finance expansion, finance wars, for example. And then more recently, the ability to provide an awful lot of stimulus to the various different economies through COVID. Do we lose that flexibility? And is it worth losing that flexibility because we're gaining that monetary discipline?
I think that discipline is paramount to economics. It's crazy because, you know, in economics is the science of how to deal with scarce resources. But our money is not scarce. That's a bit strange, right? That's a bit of a paradox to me. So of course, I think you need discipline in the system, but I also think that there are multiple gold standards. Of course, you have the classic gold standard and the gold exchange standard, but those work with fixed parities. And you can also think of, for example, if they revalue gold and more than 50 or 60% of global international reserves are made up of gold. Is that a gold standard without pegging fiat currencies to gold? I would say so, because, you know, the majority of international reserves are then gold, and gold is the world reserve currency. It's also possible that they do a monetary reset, they revalue the gold, and then to provide liquidity, they can periodically raise the price of gold. That would be an option. You know, if they do the monetary reset, maybe some investors would think twice about investing in government bonds and just prefer to hold their or a big portion of their assets in gold. And also, the thing is that with a gold standard is it always ends, right? It always ends. Or either a war breaks out or whatever, and then parity is broken. They can also say from the start, you know, gold is the centerpiece of the system. And whenever we need money, we're going to devalue against gold to create liquidity. And you know, I haven't worked it out, but I see it as an option, right? And then and it wouldn't be that bad because people would know it and keep most of their savings in gold, and you know, gain from it from an appreciation of gold.
There would obviously need to be a transition period between the two, between where we are now and a common gold standard.
Yeah,
there's two things that comes to mind when you think about that. The idea of a transition is that these things are generally made easier when there is some sort of a crisis to which this looks like it's the only answer. So I'll ask you to talk to that point in a moment. But then the second thing is, effectively, how would a transition work? What would be the impact on the average individual? From a financial point of view, from a banking point of view, from a currency point of view, how will that transition affect them? So the first one is, does it require a crisis to be ushered in? And then secondly, what's the impact on the individual? I
think, yeah, we need a crisis first before it's going to happen, because this is the nuclear option, right? You're not gonna and also with all the debt in the system we now have, I think, you know, this trick of, let's say, canceling half of the public debt, you can do this only once, right? This is not something, or people will never buy public debt again and just go for the gold. So I think it's a very delicate decision, but and you know, I'm not saying all these central bankers in Europe or across the world, in China and Russia, are all very much in favor of. They're not, let's say, gold bugs. They just have a plan B, right? You know, so that's a very subtle difference. So they wanna do this when they have no other option, and so we need a deep crisis before they do it. And it can also be pretty difficult to do, because sometimes, you know, I interpret when European central banks talk positive about gold, that they want to stimulate people buying gold, but the market isn't really doing that in my view. So they have to then revalue gold themselves and, you know, print money to buy gold, and then that can be, I don't know if they can do it in a controlled manner, because people can also panic and then rush to gold, and you know, the price goes higher than they want, or so that would be sort of a difficult. I just don't think it's that easy to revalue gold. And they also have to think about, you know, what's the percentage to cover the monetary base. They have to think about how much debt they want to extinguish or cancel. Then they have to think about, okay, we're going to set our gold price in our national currency here. What is the US doing? What is China doing? So what do we want in terms of exchange rates, right? So those are all decisions that have to be made then, and it won't be easy. No.
But as I said, you know, these things are easily or more easily ushered in when there's a crisis, and what we're seeing at the moment is multiple crises. And that is playing out very much so in inflation, whether that's energy price inflation, food inflation, and a lot of this is hangovers from massive amounts of monetary stimulus that there has been over the last number of years. So if you were to try and put two and two together in this instance, you've done the research about that common gold standard and the rebalancing of gold across countries and economies, and a sense or a feeling that from your investigations that there is this desire ultimately for this common gold standard, and that's more easily ushered in with a crisis, and we are in what looks like one of the worst unfolding financial crises of our lifetime. There's a lot of things that are lining up here at this moment in time. Would you agree with that?
Yeah, I do. Sometimes, you know, I've been working on, you know, this story about Europe and this equalizing of gold reserves and this whole framework for a number of years. And I always thought, you know, it can take another 10 years, you know, but sometimes, you know, I wake up and I read the newspaper and I think, damn, this is, you know, this can be realized sooner than I was expecting. I'm not sure, you know, if there's a recession, and they want a recession because they want to destroy demand because they can't fix the supply side. Mm-hmm. You know, and you have a recession with 10% inflation. What are you going to do as a central bank? You know, you can't. Or you can lower interest rates, but that, you know, will make the problem worse of inflation. So maybe it's quite close. I do not know. That's why I own gold. You know, I see gold as an insurance on my savings. It doesn't yield anything. You know, it's not a productive asset. But I see it as an insurance, and you know, I also and as an insurance against the stupidity of central bankers, of course, because you know, nobody thinks that central bankers will ever stop printing money, or that they can stop printing money.
And you're an investor in gold, and obviously through GoldCore, we have a lot of clients who are investors in gold. If what you're suggesting comes to pass, those who are investing in gold now should do pretty well as a result of that.
Yeah, I think if you position now, you can benefit a lot from it. Yeah, you're protected, and you can even make a lot of money. Yeah, just speculation. You know, I'm not really an investor. I see myself as an analyst. I don't like to make, you know, price forecasts or tell people to buy gold. You know, I just present my analysis, and then people can see it for themselves.
And that kind of leads me nicely on to, we're seeing the gold price at the moment under a fair degree of pressure. At the moment, it's close to $1,700 an ounce. It has been at, we have had a new all-time high in the last 12 months or so, up over $2,000 an ounce. Why do you believe that we are actually seeing that downward pressure on the gold price at the moment, given everything that you're saying, and also the backdrop where we're seeing unprecedented times, unprecedented risks, where financial risks, massive inflation, the likes of which we haven't seen for 40 years in some developing economies? How come we're seeing the gold price where it is at the moment?
I think gold is in a transition phase. So if you look at the gold price since 1968, when the gold price was unpegged in the free market, so it was allowed to float, ever since it has been correlated with real interest rates. Now, in the past, in the 1970s, it was like real interest rates calculated by, the nominal rates by government bonds, the treasury rates from the US, minus the CPI, but that's backward-looking inflation. Then when these TIPS bonds, you must be familiar with, Treasury inflation-protected securities came, you have forward-looking real rates. Those were introduced in, I believe, 2004 in the US, I believe. But the gold price started correlated very tightly with the 10-year TIPS yield from 2006 until the beginning of this year. And in the beginning of this year, the correlation started to break. And now it's sometimes more correlated to oil. There's a lot of institutional money that's driving the price of gold. And they had this model to price gold, which was the 10-year TIPS yield, which didn't make sense, by the way. I wrote an article about it, but let's not go there. And I think what you see now, the TIPS yield, by the way, is now again going up a lot. It's in positive territory. It's going up a lot, and gold should be, according to that model, around 1,500 or something, but it's not. It's hovering. So I think there's a lot of selling pressure from the old model and a lot of buying from people that see gold in a new model and have a new future for gold. So in this transition phase, I think you have to see it right now. And yeah, I think the correlation also, because, the dollar still is, but has been the world reserve currency for, since at least 1971. So this correlation to the real rate of treasuries was kind of, made sense. But also I think you can see developments now in Russia, in China, the division between East and West. The East, the developing countries, used to soak up all the American debt, bought all the treasuries, which made it possible for the US to run a persistent current account deficit. But, I don't think they are going to continue doing that. So, it's difficult to say when will this dollar hegemony or hegemony, I think it's pronounced, will end. But with this war and everything, it becomes closer and closer. I'm also a believer of the milkshake theory, so I do think the dollar is going higher for the next months and maybe year or two. But after that, there could be a shift, and I see a lot of troubles in Europe now. So the euro isn't suitable to replace it. The renminbi isn't suitable because they have capital controls, and they haven't got a rule of law in China. So yeah, I think the SDR, I just wrote an article about the SDR. The SDR can't replace the dollar. So gold has the potential to replace the dollar.
I suppose one final question. You've talked a lot about the rebalancing of gold reserves in Europe and a common gold standard in Europe, and also there has been a lot of talk, as we mentioned, alluded to, about the BRIC countries potentially, their plans to have a commodity-based or commodity-backed currency, and you also talked about potential unwinding of the dollar hegemony. Is the US at the front of this line for a new gold standard, or are they at the back of the line?
It depends. Judy Shelton was, former economic advisors of Trump were in favor of a gold standard, and some Americans are not. It's difficult to say. What I do think is that, because of the dollar being the world reserve currency, and that sort of requires that the US is running a current account deficit, that leads to, that the industries in the US have collapsed. In the 1930s or 20s, a lot of very high quality products were being made in the US. That's all gone. All these people in the Midland don't have a job. They're addicted to heroin. There's a lot of social instability in the US. So they could, decide to devalue the dollar and start exporting again and rebuild their manufacturing base.
Yeah, it's been absolutely fascinating talking to you this afternoon. There's some incredible insights there, and I encourage anybody watching this to follow your research and have a look at your articles. You're active on Substack, I believe, is that correct?
No, actually, I work at Gainesville Coins. That is a coin dealer in Florida. So if you go to the website of Gainesville Coins, there's a tab with blog, and I first published my articles there. I used to have a Substack, so after a week or two, I also copy the articles to my Substack account just to have a depository for all my articles. But I write for Gainesville Coins now.
Superb. Well, what I'll do is we'll put a link to your site in the description and show notes below this, and anybody that wants to follow up, I'd highly recommend Jan's research. But for now, Jan Niewenhuijs, thanks for joining us on GoldCore TV.
My thanks to Jan for joining Dave Russell on GoldCore TV. If you'd like to see more of his work, then please subscribe to his Substack account. If what Jan said about central bank gold applications and a move to the gold standard has inspired you to consider how best to position yourself for a major shift in the global economy, then please head to goldcore.com, your precious metals experts. And don't forget to check out the rest of GoldCore TV. If today's show has made you want to delve deeper into what is going on with the economy and precious metals, then may I suggest you watch our wealth of information and interviews and our brand new show, the M3 Report, with guests such as Jim Rogers, Jim Rickards, Mark Faber and David Morgan, as well as commentary from the GoldCore team. The M3 Report is must watch for anyone interested in metals, markets and money. Until next time.